Good evening, everyone. By way of introduction, my name is Hugh Wedlock, and I'm Director and CEO of the Fry Group here in Singapore. And I'm going to be your host for today's webinar, which we've entitled Making the Most of Your Retirement Income. Here's our agenda for the webinar today. Firstly, we're going to talk about the macroeconomic environment vis-a-vis generating investment income. We're going to talk about the types of investment income that are available to you. And we're going to talk about how we help you figure out at the Fry Group whether you have enough of that income. Then we're going to move on to tax, and we're going to consider how your income is taxed in the UK and how you might think about optimizing for tax. And finally, we will do a bit of a drill down into the UK pension system. Then we'll have time for a little bit of Q&A, which I will host. If you have any questions during the course of the webinar, please feel free to put them into the normal box on your Zoom screen. And we'll try and get through as many of those as we can towards the end of the session. We are expecting the session to last in total around about an hour today. Luckily for you, it's not just me doing the talking. I've got a couple of subject experts with me. Firstly, Peter Webb, who many of you will know as our Head of Tax Advisory. Peter will be doing the tax part of the webinar. And then George Howard. George is one of our chartered financial planners based in Dubai. George will be going through the drill down into the UK pension system. So without further ado, let's get going. And in investing or retirement planning, time is your greatest asset. And I think good thing to say at the moment is that it's probably an easier time now than it has been for some years to generate a decent level of income from your investment portfolio. Why is that? Well, let's have a look at this slide in order to try and answer that question. What it shows you is inflation and interest rates in the UK since 2009. And on this slide, you can see the dramatic increase in inflation that has occurred since the second half of 2021. That's the blue line that you can see there. As a result of that inflationary pressure, central banks like the Bank of England have begun to dramatically increase interest rates. And that's the red line that you can see at the bottom of the page. It's clear that from a macroeconomic perspective, the world has changed a lot over the last 12 months. And we've seen a transition from a low inflation and low interest rate environment that's been prevalent ever since the GFC to one where prices are rising more rapidly and inflationary pressure is much higher. And it's clear that in the medium term, interest rates will be higher as a result of that inflationary pressure. Now, this also dramatically changes the levels and sources of income that are available to you as an investor. In 2022, the global equity market went down almost 20%, and the global bond market went down 15.5%. Now, remember that the yield or income that you receive from any investment has an inverse relationship with its price. So the decreases in value of the equity and bond markets that we've seen in 2022 mean that they now offer an investor significantly higher income yields than they did back on the 1st of January 2022. And at the same time, it's more important than ever to secure diversified sources of real return from your portfolio. Because if you don't do that, then there is more chance that your overall purchasing power will be eroded in what has become a more inflationary world. So, what are the potential sources of income that are available to me as an investor? Let's examine those. And firstly, interest from cash holdings. Now, your cash holdings will pay you some interest, but these interest payments are unlikely to keep pace with inflation in the current environment. And your purchasing power is likely to be eroded if you hold large amounts of cash on deposit over the longer term. If you own a bond or a bond fund, they will generate coupon income for you from those bonds. Now, remember that globally, bond prices have gone down by 15% or over 15% in 2022. So their yields have increased. Let me give you a specific example. I could buy the bond of Boeing, the substantial American aircraft manufacturer. I could lend money to them to 2031. And if I bought their bond maturing in 2031, I would get two things. Firstly, I would get an annual income, a coupon from that bond of 6.2% per annum for the next 8 or so years. And then at 2031, I would get my capital back. So that is a very good return for lending to what is a very solid company. And we could sort of look at a number of areas where the yields on that you can get from the bond market are very attractive. If you buy equity, then you should receive a dividend from it. And dividend income is a very important source of income in the long term. Dividend income will on the whole be lower than the yield that you get from a bond. But importantly, dividends should increase over time at a rate that is equal to or higher than the prevailing rate of inflation. So some form of equity investing is very important in terms of combating higher inflation levels. Equity is also important in that the total return that you receive from any investment is the sum of two things. Firstly, the income that it generates during your holding period, and secondly, the capital growth that it achieves. So in the long term, good quality equity should provide you with both a reliable source of capital growth as well as that dividend income. Property income. Well, in the UK, that's been traditionally a very stable way of obtaining income. It's worked well in the past. But barriers to entry into that market are now quite high in terms of the tax barriers that the revenue have put in place to combat multiple property ownership. And rising interest rates are now precipitating a correction in that market, the extent of which is currently quite uncertain. Finally, pension income. Now, depending on where and how you've spent your working life, you will have more or less of this. But firstly, tax relief on contributions, and secondly, the ability to draw down from a UK pension flexibly, potentially make pension saving in the UK fairly attractive. And George is going to say a little bit more about that later on. Now, if I put all of these sources of income together, how much income should I be able to take from my portfolio? Well, a safe withdrawal rate for a balanced investor is thought of as somewhere between 3.5% and 4% per annum. Now, that could alter slightly depending on the age that you are at when you retire. If you're slightly older, when you retire, potentially that number could be slightly bigger. And if you're retiring at a younger age, then vice versa. But it's helpful to think of that safe withdrawal rate as almost your neutral position. Of course, potentially you could choose to take more income from your portfolio over time, as long as you were comfortable with some capital erosion of it. So, to summarize from a financial planning point of view then, we think it's optimal to have a liquid portfolio of investments that can offer you a number of opportunities for both capital return and income, and that has been tailored to suit the amount of investment risk that you want to take as an individual. So I'm going to round off by saying a few things about cash flow planning, and a common question that we're asked as financial planners, irrespective of where we are, is when can I retire and how much income can I have in retirement? Specifically, how much income can my capital generate? So how do we try and answer that question? Well, we model it, and we use a cash flow model. And what you're looking at is the output from one of those models. Now, when we go through this process, we have to make some assumptions. We make three key assumptions. Firstly, we have to make an assumption about the amount of growth that your portfolio is going to achieve over time. Secondly, we make an assumption about the prevailing inflation rate during the course of the forecast, or during the life of the forecast. And lastly, we also make an assumption about the income that you're going to require. And that can move up and down over time. It's important to point out that cash flow modeling is an iterative process. We can run the model for you a number of times in order to increase its overall accuracy. But if you remember the concept of the safe withdrawal rate that we talked about earlier, well, this is where we try and put a number on that and illustrate how much income you can take before you begin to erode capital during retirement. So let me just run through this example for you quickly. And what you can see on the left-hand axis here is this particular individual's capital position over time. And on the bottom axis, you can see their age as well as the age of their spouse. And if we run through this forecast, you can see that we start forecasting when this individual is 58. And at the age of 58, this individual carries on working for 4 years. So that's why you can see those bars representing that individual's capital position rise ever so slightly over the first 4 years of the forecast. They're working, they're saving money. Then at the age of 61, they decide to retire. And from the age, at the age of 61, they have a total capital position of around £2.5 million sterling, which you can see on the left-hand side there. From the age of 61, they decide to take £130,000 per annum from their portfolio. And then at the age of 75, they tear that down slightly. Perhaps they're slightly less active by that point, and they start taking £95,000 per annum from the forecast for the age 75 to 90. So when we get to the end of the forecast, on the right-hand side of the page, you can see that this individual still has substantial capital available to them, just under £1 million worth of capital at that point. So to sort of sum up a little bit, hopefully you can see a number of things from this forecast. Firstly, that this individual has had the retirement they want. Hopefully they've had an enjoyable time, but importantly, they've had the income that they required throughout that period. And at the age of 90, they still have substantial capital that they can use for perhaps long-term care requirements or just to pass on to their beneficiaries at some point. So to recap, we've covered the current macroeconomic situation vis-a-vis generating investment income. We've looked at the types of income that you can draw down on during retirement, and we've had a very quick look at how we model that. Now, before I hand over to Peter, we're going to have a quick poll question, which should be coming up on your screens any moment now, and there it is. So the poll question is, at what age would you like to achieve financial freedom? Obviously, that means different things to different people. But at what age would you like financial independence, for example, or be able to retire? So go ahead and vote, and I'll leave you to that for a second. Should have some answers any second now. And there we are. Similar results to the session we did earlier today. 60 to 65, still comfortably the kind of range of ages that people feel they want to be financially independent by, or perhaps be retired by. So that is interesting. So at this point, I'm going to hand over to Peter, who is going to talk through making your income as tax efficient as possible in the UK. Peter, over to you.
Thank you, Hugh. So where you retire is going to be the biggest determining factor on the tax you'll pay in your retirement, which then determines how much of the income and gains you earn you will get to keep, how much is actually going to end up in your bank account. If you retire in the UK and you're what we call a UK domicile, you're going to pay UK tax on your worldwide income and gains as they arise. And actually, if you are retiring in the UK, you are likely to be UK domiciled eventually, even if you're not UK domiciled now. The UK tax regime is confiscatory. Income tax rates, well, they're 20% to 45%. Capital gains tax rates, 10% to 28%. And we know that tax allowances in the UK, which lessen the amount of tax you pay, are being reduced over the next couple of years. And it's not impossible that we're going to see UK tax rates increase too. And we have another budget statement coming up next month. But don't be put off by those comments about UK tax. If you're retiring in the UK, you can certainly make a plan for tax efficiency. There may be more work to do than in other less confiscatory tax regimes, but we can certainly help you with a UK tax efficient plan. However, if you're not going to retire in the UK and you can be what we call not UK tax resident in your retirement, then your liability to those really high UK tax rates is going to be much more limited. You will generally remain taxable on your UK sources of income, but your non-UK income, your overseas sources of income, will escape UK tax. And we think about UK capital gains tax, the tax you pay when you make a profit, when you get rid of something, when you sell something, when you dispose of it. That UK capital gains tax could only be limited to perhaps just UK land and property, and with all other capital gains escaping UK tax. Just pause there for a second. If you are retiring overseas, it's really, really important that you take appropriate advice in the country where you will be retiring, or indeed any other relevant countries for you, to make sure that you know how much tax you're going to pay in those countries and what reporting requirements you may have, what tax returns you might need to submit, for example. So if you do retire overseas, if you're living overseas and a tax resident in a country which has what we call a double taxation agreement, a double tax treaty with the UK, then that tax treaty then decides which country gets to tax your UK income. And this can lead to some really interesting and surprising results, some of them really favourable for you. For example, if you're a resident in Dubai and you have UK pension income, that UK pension income will generally be taxed in Dubai and not subject to UK tax. Now, I'm a UK tax advisor. I can't comment on Dubai tax rates, but I think you'll find those Dubai tax rates are very favourable indeed at the moment. UK state pension. Your UK state pension is a taxable source of income. But if you've retired outside of the UK, you may not have to pay UK tax on your UK state pension. And that's going to depend on the relevant tax treaty between the UK and the country where you've retired. But it's worth remembering that although the UK state pension income may not be taxable in the UK, it may well be taxable in the country where you are living. Now, George is going to talk to you about pensions in quite some detail, so I'm only making some really brief comments here. I think what I would say, though, what I would emphasize, it's really important to know that if you are living overseas, your UK state pension may not increase each year. So generally, to benefit from that annual increase in the state pension, you need to be living, well, in the UK, of course, but a European Economic Area country, Gibraltar, Switzerland, and other countries. There are a few of them that have a specific social security agreement with the UK. But inflation is increasing. We've seen really high inflation rates. So imagine that if you're living in an overseas country, you're not getting that annual increase in your state pension. But how is that going to affect your retirement income in, say, 25 years' time? So moving on to our next slide, we need to think about your sources of income. It's important to know how much tax you're going to pay on the income and gains you'll receive in your retirement. Without some careful planning, tax can significantly reduce your income. Imagine that you're entitled to a UK pension. but you're going to pay 40% on that UK pension income. And that's really not unlikely. You need to know that your pension income is going to be reduced by 40% before that actually happens when you plan for your funding in your retirement. So just really briefly on a few bits and pieces that we see on the slide here. So your UK resident, your UK domiciled, then dividend income, wherever they arise in the world, they will be subject to UK tax. From 6th of April 24, it's only £500 that you can receive without paying tax for dividend income. Interest income, wherever it arises in the world, the allowance on that could be anything from £0 to £6,000. You need to know what that allowance is for you. Capital gains, your UK resident, your UK domiciled, you're subject to UK capital gains tax on worldwide gains. And from 6th of April 24, that capital gains exemption is just £3,000. We have this thing called a chargeable event gain, which attaches to a very specific investment that you would make, which is what we call a non-qualifying life insurance policy. So if you have one of those, you'll know about this. Chargeable event gains arise on those types of policies in some instances, but generally, actually, those kinds of investment policies are generally very, very tax efficient. Property income, whether the property is in the UK or overseas, your property income is going to be taxed at your highest rate of income tax. And selling the property, if it's a UK property, is always going to be within the scope of UK capital gains tax, irrespective of your UK resident status. State pension, pension income, taxed in the same way, so rates of 20%, 40% and 45%. I've very briefly run through the state of play if you're UK tax resident, but bear in mind my earlier comments about being non-UK tax resident. If you can be non-UK tax resident, it's a game changer in respect of your liability to UK taxation. So we'll move on to our next slide. So being non-resident, retiring in Dubai, but apart from retiring in Dubai, what else can you do to reduce the tax you're going to pay in your retirement? The first part of your plan is to pay less taxes, to work out how much income you're going to need to live on each year through your retirement. Once you've decided your retirement income needs, you look at your assets with an investment manager to work out how those assets can fund your living costs. And a huge part of that plan will also be to involve a tax advisor to work out how much tax you're going to pay on the income that you need. Coming up with a plan to be tax efficient with your investments is going to be very, very individual to you, depending on your income needs, lifestyle, desire to pass on wealth to the next generation, for example, your asset base, your sources of income. Considering in which order to draw income from your investments and assets can be really, really important too. We haven't touched on inheritance tax, which is generally a 40% charge. Now, if you look at our website, we've got webinars, we've got resources that can help you understand inheritance tax. But a general principle to mention here is that you draw down income from assets that are protected from that 40% inheritance tax charge last of all. For example, your UK pension, that's going to be protected from that 40% inheritance tax charge, and in some circumstances can be passed on to your beneficiaries free of inheritance tax when you pass away. So I think at this point, it's a great point to pass on to George, who's going to tell us a little bit more about pensions.
Thanks so much, Peter. So my name is George Howard, and I'm a chartered financial planner. Today, I'm going to talk about the UK pension system. So I have to say, I absolutely love pensions. They've changed so much over the years to what they've become today, but they are an excellent way to save tax efficiently for retirement. So as you can see from the next slide, there are quite a few different types of pensions that are available. This list is not exhaustive that we've put on here today, but what we're going to do is to focus on a few different types of pensions and the most common ones that you will see. So if you work in the UK, there are three main ways you might build up your pension. You can have a state pension, a workplace pension, or indeed ones that you set up yourself. So workplace pensions are set up by employers. You usually have the opportunity to join the scheme when you start work, and the employer normally pays into the pension with you. So there are two types of workplace pensions, the defined benefit and defined contribution. It's also worth mentioning that when you work for an employer, even if it's a really small business, they still need to set up a workplace pension to enroll you into it. So coming on to the next slide, I'm just going to drill down a little bit on defined benefit pensions. These are also known as final salary pensions. So this is a type of workplace pension, but the benefits are based on your salary and how long you've worked for the employer. If you're a member of this type of scheme, you're not responsible for the investment decisions. So your scheme promises to pay you a retirement income. It's actually your employer that makes the investment decisions and chooses the risks needed to reach the target. Now, some of you may be fortunate enough to have this type of arrangement. You may have collected one or two along your career. However, these are quite rare now, although some of the public sector still enjoy these. There are excellent schemes. These are excellent schemes, and because they offer a guaranteed inflation-proofed income when you retire, they provide a really solid foundation for that retirement income that you're wanting to take. So on this slide, we're just talking about defined contribution pensions. And just to say, this does also include personal pensions. This is really how they all work. So this is the most common way to save for retirement, to build up a tax efficient pot of money. The main difference between a defined benefit and defined contribution scheme is there are no guarantees with this type of arrangement. It's going to rely completely on the investment element, building a large enough pot of money to support your income needs in retirement. So every payday, a percentage of your salary is put into the pension scheme automatically. In most cases, your employer also adds money into the pension. If you choose not to join the company pension scheme, this is really like turning down a pay rise. So it is advisable to join as soon as you're eligible to do so. There's no limit on how much you can save into pensions each tax year. However, there are limits on how much tax relief you will receive. The money also grows tax-free within the pension, so there's no income tax and no capital gains tax applied to the pension pot. Now, workplace pensions do tend to be low-cost schemes, usually with a limited range of investment options. So if you don't choose a fund, the default fund is likely to be what's called a lifestyle fund. This is where your money will be invested in different asset classes. And then what will happen is as you approach retirement age, the scheme will actually reduce the risk by reducing the amount you have in the higher risk investments like equities. And therefore it's reducing the risk overall for you closer to retirement. Now you might accumulate different pensions over your career. The most important thing is that when added to your other assets, they provide you what you need to fund your retirement lifestyle. As the amount of money grows to more substantial sums, you may indeed want to involve a professional to look at the investment strategy and also to ensure that you're on track to achieving your financial freedom in the future. So coming on now to talk about taking your income from the pensions. So in April 2006, the government brought in pension simplification. I've got to tell you, it was not simplified by any means. They tried to simplify pensions generally, but they also added some huge complex rules around the allowances that you can take. So the biggest change was that you no longer have to take an annuity. Now, this is a type of pension for life, commonly for you and your spouse, payable until you both die, and then the benefits would have died with you. Now, with a defined contribution arrangement, this enables you to pass on benefits to your spouse and future generations in totality. So a defined benefit pension is very rigid in how the benefits are paid. Just to touch on this briefly, usually at scheme retirement age, you have the option of drawing just a taxable income, or you can take a tax-free lump sum and what we call a reduced income. Of course, if you take benefits early, your income is effectively going to be paid to you for longer, and your income will be reduced to take this into consideration. With a defined contribution arrangement, when you reach age 55, you can use the money in a way that suits you best. So that might be taking a guaranteed income like the annuity I've just described, taking a flexible income, or you can choose to take a mixture of the two. You can take up to 25% of your fund as a pension commencement lump sum. This is the tax-free amount, but that is subject to limits. And the rest is paid to you as what we call a taxable income. With flexible access, your savings remain invested in your plan. You can then choose the level of income to enjoy. Indeed, you can choose to take no income if you don't want to. Just coming back to what Peter said a moment ago, pensions are very, inheritance tax efficient. And so if you leave this pot last to take money from, it is extremely efficient for the future generations. Before you start paying tax on your income, you have something called the personal allowance. For this tax year, this is £12,570. Any tax-free cash that you take doesn't count towards this personal allowance. So just coming on to some of the limits that you have. So obviously with the government giving you all that lovely tax relief up front and then tax-free growth on the money, they do limit how much you pay into your pension each year, benefiting from tax relief. So as you can see from this slide, you can pay the lower of 100% of your earnings or £40,000 gross. So I'll just give you a brief example. If you earn £20,000, then your limit would be £20,000. Excuse me. If you don't have any more earnings, the most you can pay into a pension is £3,600 gross. Now you would actually pay £2,880 net, and then 20% tax relief would be added, making it £3,600. So just to note as well, for non-taxpayers, you can still benefit from that basic rate tax relief. So they're very tax efficient. In fact, we often get people starting pensions for their children and their grandchildren for exactly this reason, because there are a few investments that are going to give you a 20% uplift in the value immediately. But do remember, this is a pension, so you can't access the money until you reach at least retirement age. Now, sometimes it is a good thing to pay a tax charge. So I have a client where his company are willing to pay 20% of his basic salary into his pension. If he doesn't accept this offer, the company are not willing to pay it into his salary instead. For his individual circumstances, it is beneficial for him to accept the company contributions and pay the annual allowance tax charge. The tapered annual allowance is there for higher earners. And what this can do is reduce your allowance from £40,000 to as low as £4,000 a year. This tapering can start if you have income over £200,000 a year. Next, we have the carry forward allowance. So once you've used the current tax year's allowance, you can use this allowance called carry forward. So what this enables you to do is to use the previous 3 tax years' allowance if you haven't already used them. This is really beneficial if you receive a bonus. Sometimes if you're made redundant, that can be useful. And also as you're approaching retirement in the year before or the year you retire, it can also be really beneficial. The last one to just explain to you is the money purchase annual allowance. So this is triggered when you withdraw income from your pension. Just to be clear, this doesn't include tax-free lump sums. And what it's designed to do is to limit the amount you can benefit from tax relief after you start drawing your pension benefits. So I'm just going to say that again. You can take your tax-free cash and not take income, and you'll still be able to pay in your full allowances into your pension. If you start taking taxable income from the pension, you're going to be limited to the money purchase annual allowance, which is £4,000. Now, if you exceed the allowances detailed here, you will suffer a tax charge. All of these have really complicated rules, and we would recommend you seek professional advice to understand your specific circumstances. There are other tax efficient investments that can be used aside from pensions if required. Now, coming on to the lifetime allowance. So this takes into account all of your pensions, including pensions in payment, but not your state pension. The allowance is presently £1,073,100, and this allowance has been frozen until 2026. There are lifetime allowance protections that enable you to have a larger limit. It is important that you let your advisor know if you're fortunate enough to have this, and they can provide you with the best advice for your circumstances. Your protected lifetime allowance will be registered through HMRC, and you should have a certificate confirming your higher allowance. Now, this tax charge is triggered when a benefit crystallisation event occurs. You cannot avoid the tax charge. However, you can take action to try to reduce it. Examples of benefit crystallisation events are when you take the tax-free cash, when you take income, when you pass away, and there's an automatic test to age 75. The next slide provides a case study, which I'm going to talk through with you, which better explains this really complex topic. The tax charge levels are based on whether you take the excess as an income or a lump sum. You can potentially reduce your lifetime allowance tax charge, and this is best achieved with working with your professional advisor who understands the methods to accomplish this. Avoiding the charges shouldn't necessarily be your default position. You should think carefully about whether stopping contributions to avoid the charge or staying in the scheme and paying the charge will leave you better off in the longer term. So I have had previously clients that have said to me once they reach the lifetime allowance limit, let's just stop growing the pension. I don't want to pay any more tax. But my logic is they will receive more money from their pension net of the tax charge than by not letting it grow. Also, imagine if legislation changed in the future, increasing the allowance, for example, then you'd be kicking yourself if you hadn't let your pension grow. So I'm going to come on now to talk about the lifetime allowance, and this is the example. So just starting from the top, you can see the value of total pensions is £1,273,100. So that's effectively £200,000 over the allowance. And what I've done is to separate out the different elements when taking them from the pension. So the green part is the tax-free element. This is your pension commencement lump sum. You're able to take 25% of the lifetime allowance, which is £268,275. And then below that in the yellow box is the taxable income element. So on this side, on the left-hand side, you're just taking the elements within your lifetime allowance limit. So there is no lifetime allowance tax charge while you're doing this. However, if we cross over to the right-hand side where that £200,000 is in the orange section, this would trigger a lifetime allowance tax charge if you take the money out. Now, the level of tax you're going to pay is shown on the right-hand side, and that depends on whether or not you take the money as a lump sum or an income, and then it will be subject to income tax after. Just on a separate note, we've just noted at the bottom, and we have said this a few times, that the defined contribution pensions have no inheritance tax. So they're a great way to pass money efficiently to the next generation, which leads me really nicely onto my next slide, which is for when you pass away. Now, one of the biggest changes that came into effect in 2006 was the ability, when you die, to pass the defined contribution arrangement to your dependents. It's worth mentioning that once you die, there are no more tests against the lifetime allowance on your pensions. So depending on what age you actually die will depend on the income tax payable by the beneficiary if they choose to draw income or lump sums from the pension. This slide is just going to show you in more detail how this works after you pass away. So starting at the top of the slide, if you die prematurely before the age of 75, any money taken from the pension is tax-free to that beneficiary. The age that person then dies dictates the tax on the pension to the next beneficiary. I'm just going to explain this in an example because it is quite complicated. So the person whose pension it is, let's imagine they die prematurely at age 65. The first beneficiary will pay no income tax on any money they take out. If that beneficiary then passes away at, say, age 83, the money then becomes subject to income tax at the beneficiary's marginal rate of income tax. Remember, though, this is only if they take money out of the pension pot. So each time someone passes away, the pot gets split to the beneficiaries according to their wishes. So it is really important to maintain your current beneficiary wishes with your pension provider. I've shown how a family may view their pension passing through the generations on this slide, just coming down. So you see you've got the spouse's pension, they have 2 children, and then they've got 3 grandchildren with one of their children, and the other one has no children. So this is basically passing your money free through the generations of inheritance tax, and also the pot is going to grow tax-free. So it's certainly food for thought when you're looking at inheritance tax planning. We do suggest that people actually use their pensions last when they're providing income in retirement. Please also note that on the death benefit rules for pensions, inheritance tax is completely different. So do refer to our resources section on our website. We're just talking about pensions today. So the last slide, I just want to touch on if you live outside the UK, these are just some top tips for you to be thinking about. So maintain the savings that you were doing as a minimum. As a rule of thumb, we suggest that you save at least 20% of your income towards your short, medium and long-term goals. Make sure the vehicle you're saving in is flexible. I know it sounds really simple, but being an expat means you could go home or to another country relatively short notice, and we definitely saw that a lot during COVID. So make sure there's no tie-in periods and that you can access your money with no penalty. Any investment strategy needs to look at both your present and future tax position where possible. Again, as expats, we don't always know where we're going to end up, and we may not necessarily go back to the UK. You can continue to pay your national insurance stamps to accrue qualifying years for your state pension in the UK. Now, this next one, not a lot of people know. So if you already have a defined contribution pension, you can continue paying in for the tax year that you leave and up to 5 tax years after. The limit, if you have no taxable earned income in the UK, is £3,600 gross. So coming back to my example earlier, you only pay £2,880, then you get the 20% income tax relief added. That doesn't matter if you pay any UK tax in the UK, you will still be entitled to that. If you continue to have earned income and pay tax in the UK, then you are subject to the limits already set out earlier. That was the £40,000 gross, if you remember. So just to be clear, it is only earned income from employment. If you own a rental property and you get rent from this, that is not classed as earned income and cannot go towards an allowance to pay into a pension. So when your circumstances change, just make sure you do speak with a qualified advisor to ensure that there's nothing that you've missed in your finances that needs to change. Sometimes it's only after the event, which is often too late. Thank you so much for listening to me today. I'm now going to pass back to Hugh for your questions.
Peter, thank you, George. That was excellent. George covering off in inverted commas pension simplification there. You know, who says they don't have a sense of humour at the revenue? Right, now we've got about 10 minutes for Q&A. So we've had quite a few questions come in via the normal route, and we will kick off as quick as we can and try and get through as many of those as possible. Peter, I'm gonna start with you. A couple of questions for you, if I may. The first one is, what's the most tax efficient investment that I can make?
Oh, wow, what a fantastic question to start. I love this question, actually. So there is no right answer to this question. It's going to depend on your circumstances, your asset base, what are your aspirations in terms of your wealth and your funding in retirement? How much of your wealth do you want to pass on to the next generation, if at all? So it's going to be a very individual plan that you're going to come up with between you, a tax advisor, and an investment advisor. So I'm going to kind of duck the question a little bit. It's very personal to you. Speak to the professionals. We will be able to help you come up with that tax efficient plan.
Okay, thank you. Second question. If I am not UK tax resident, will I still be taxed on my UK income?
Yeah, another great question. And again, it depends a little bit. So there are usually double taxation agreements between the UK and the country that you're living in. And if that's the case, that double taxation agreement is going to determine which of those two countries, the UK where the income arises and the country where you're tax resident, who gets to tax your income. UK property income will always be taxed in the UK, no matter where you're living. Gains arising on the disposal of UK land and property will always be taxed in the UK. But things like dividend income, interest income, pension income, these are the sources of income which are going to be determined by a double taxation agreement.
Excellent, thank you, Peter. George, pensions question for you. How can I find pensions that I've lost the details for?
So there is actually a website that you can use in order to find lost pensions. And quite often, if you can just work out the company that you work for, your advisor might be familiar with the pension scheme that they run. I know it's really easy because you just kind of lose track of pensions over the years, but working with an advisor, they can help you find those and work out the best strategy for you.
Okay, thanks, George. So Peter, it's back to you, and we've got an IHT question.
Okay.
From one of the attendees, he has asked, does inheritance tax apply if you die after 75 years of age? And is the tax payable determined by the tax rate of the beneficiary or something else?
Oh, this is a great question, actually. So, no, age is immaterial. Inheritance tax will apply when you pass away, whether that's under 75 or over 75. But do watch those specific rules around pensions, which George talked you through about the age of 75. I think that's where the 75 age becomes significant. The rate of inheritance tax you pay is determined simply by the legislation. It's set at the normal rate of inheritance tax is 40%. That can reduce to 36% provided that you leave enough of your estate to charity. There's a lifetime rate if you gift assets to trust, for example, that could be 20%. Inheritance tax is one of those taxes which you can plan for, provided that you're aware of the problem with enough time to make that plan. So I think it's always a great idea to talk to an advisor to understand what your exposure to UK inheritance tax is at that point, and then come up with a plan to reduce that inheritance tax bill.
Great, thank you, Peter. I'm relieved to see there are a few financial planning oriented questions in here as well. So I'm gonna take one myself. The question that we've had through is, am I taking enough investment risk to meet my overall objectives? And I'm going to pick two words out of that sentence. The first is objectives, and the second is risk. It is incredibly important in the financial planning process to understand correctly what someone's objectives really are in terms of the financial planning that we're doing. Because bringing this back to investment risk, there is not a lot of point in us planning to grow someone's capital base if that is already perfectly adequate for the objectives that they have in retirement. That's kind of investment risk that you don't really need to take. So that's the first thing to say, is that quantifying someone's objectives accurately is an absolutely vital part of the financial planning process. Second part is risk. There are two elements to this. Whenever we're trying to ascertain the correct level of risk to manage someone's money to, there are two elements to think about. The first is, does the individual that we're talking to have the capacity to take investment risk, and if so, how much? And secondly, how do they feel about investment market volatility? So the actual value of their assets going up and down. It is both of those elements that we need to constantly watch. So we do need to think about how you feel about markets going up and down, but we don't want to give you a portfolio with an awful lot of investment volatility if you don't have the capacity to soak up that volatility over time. So I think, coming back here, just to summarize a little bit, we need to correctly ascertain what your objectives are, and then we need to think about both your capacity for risk and how you feel about markets moving around, because move around, they certainly will. So that's investment objectives and risk. I'm going to go back to George. George, we've got a couple of PCLS oriented questions here.
Okay.
Which I'll ask you to have a go at. So the first one is, if you choose not to take a PCLS and instead only take income from your pension pot, is all of that income taxable, or will there be a tax-free element because you didn't use your PCLS?
That's a really good question, actually. So nowadays, lots of people, what we call phase in retirement. So they might be still working, taking smaller sums and not need to take the tax-free lump sum, the pension commencement lump sum. So yes, you would be able to take, some schemes allow you to take the income as both tax-free and partly taxable. You can just choose to take the tax-free element and trickle that in, but it does depend on the provider that you're with, because not all of them do allow that. But no, really good question.
Thanks, George. Peter, a bit of a topical one for you on the tax side. There is a budget coming down the track in fairly short order, and we've got a question around, are we expecting any big changes in terms of the areas that we've talked about today?
It's very hard to know. You're gazing into that crystal ball to try and understand what Jeremy Hunt's going to do next time around. The UK economy is not in great shape. There's a huge amount of debt there. The last autumn budget statement kind of nibbled at the edges a little bit. I would expect perhaps some further rule changes around pensions. You ask a tax advisor, are there going to be any changes? Say, changes to pensions, there's always changes to pensions. I think that's one to watch. We didn't see really any increases in headline tax rates last time around. And I wouldn't be completely unsurprised to see perhaps capital gains tax rates increase. They are at historic lows. But no, I think there are going to be some rabbits pulled out of Jeremy Hunt's hat this time around. Pensions, I think, are an easy target. Yeah, wait and see.
Great, thank you. I think we've got time for one more. So George, it's another PCLS oriented question for you, actually. And the question is, once you take your PCLS from a SIP, so from a self-invested personal pension, the age of 55. Are you able to save into another pension scheme if you're still working?
Yes, that's a really good question. So if you're only taking the PCLS, then yes, you can carry on to the limits that we showed you before, so the £40,000 a year gross. However, if you start taking any of the taxable income from the pension, then you have the money purchase annual allowance that limits you down to the £4,000 a year that I covered earlier. So just to be clear, if you just take the tax-free cash, you're absolutely fine to carry on paying into a pension.
Great, thank you, George. We're running out of time. Peter, George, many thanks for all your contributions today and for getting through so many of those questions. That's excellent. Thank you very much.
Thank you.
Great. Okay, so it's just down to me to close the session today. I'll just wind my slide on. And I will do so with a quick word on the Fry Group. Many of you will know quite a bit about the Fry Group already, but just a quick reminder, we are a UK headquartered tax, financial and estate planner, and we were formed in 1898. And currently we have offices in all the jurisdictions that you can see on this slide. Our mission, if you like, is to help people achieve financial freedom. For different people, that can mean different things, but that is the mission that we have as a company. I'll round off by saying, please feel free to get in touch with us, even if you just want to know a little bit about what it is we do day to day. And I hope you enjoyed the session today, and I look forward to speaking with as many of you as I can very soon. Thank you very much.